There are 5 main reasons why investing in the Canadian energy sector is a great opportunity right now. Supply, demand, valuation, balance sheet, and an ESG perspective. I think we're actually relatively early in this energy cycle. In the past, we've seen energy bull markets last anywhere from 6, 7, 8 years plus. So since oil crashed and went negative about 4 years ago, we've been in this mini 4-year bull market for energy. But there's lots of reasons to believe that this cycle is going to be different. It's going to be longer and extended. We know that energy demand tends to rise with population and GDP growth. We had the dip during COVID, you had the dip during the 07-08 recession, but over the very long term, oil demand growth tends to follow population growth and GDP growth. We know that there's going to be some transition to electric vehicles that's going to hurt some of the demand from domestic markets, OECD countries. But really, it's all about emerging markets, the BRIC countries, China, India. As populations move from rural to urban settings, their energy intensity increases, and that's where all of the demand growth is coming from for energy. And then on the supply side, there's lots of reasons why you're not going to get supply coming on when energy prices rise again. ESG reasons, regulatory reasons, egress reasons. You're going to get incremental growth off of existing projects, but they're just not discovering the major new oil sands anymore. North Sea is starting to be in decline. Even the shale, the best locations have already been drilled. You have limited supply growth with growing demand, and that's a good setup for the supply-demand fundamentals for energy moving forward. The biggest change that we've seen is in the actual companies. They used to only be compensated for growth, and that has all changed. In the prior oil cycle, when oil was above $100, there was lots of excess cash flow to spend on CapEx. However, when we saw oil fall from the $100 plus level down into the $50 plus or minus level, we saw the beginning of a change here, where it was a combination of not having the cash to invest, but also not finding the discoveries that were found in the prior cycle. When you're not spending on future growth, it means you have a lot of excess cash flow that needs to go somewhere, and it's either being spent on buybacks or dividends. Investors have changed their mentality to demanding that management teams focus on return on invested capital, return to shareholders, and not on pure growth. Sure, they still want growth, but not at the expense of profitability. So it's those full cycle economics where if a company were to announce a big increase in their capital expenditure at the expense of returning cash to shareholders, they would be punished in the market, their stock would fall, and they're not doing it. That's another reason why supply is being capped. Companies are being rewarded for profitable growth. The good thing about Canadian oil producers is most of them have very low costs of production. They've spent their tens of billions of dollars to build out their massive oil sands mines, and now they have 50 years of production with very low declines. The highest quality companies, the best companies in Canada, their share price might not be rocket ships like an NVIDIA or a Microsoft, but we think that even if the valuations stay where they are, because of those dividends and buybacks, we think that there's going to be an attractive investment outlook for the group as a whole. You really have to think about the move away from carbons. It's a global problem. It's not a local problem. And every barrel of oil produced in Canada means 1 fewer barrels being produced in countries like Venezuela, Nigeria, Iran, Iraq, where not only the environmental, but also the social and governance aspects are far inferior to what they are in Canada. From an overall ESG perspective, it is very attractive to be investing in Canada relative to anywhere else in the world. The best part about working at CIBC Asset Management is the strength of our broader team, the collaboration between all the portfolio managers and analysts. You're getting the collective strength of the entire team. And I would argue that our analysts are amongst the best analysts on the street. Dan Greenspan and Leo Han are some of the strongest energy and resource analysts that I've seen. Investing in our funds, you get the benefit of their expertise.